Yeah, I'm excited to interview you here and hear more about your story of going from an investment banker, which I think a lot of people think of as sort of like a pinnacle top career that you'd aspire to converting from that to building generational wealth now through short-term rentals. And I'm really interested in what inspired you to make this transition and all the lessons that you've learned since I think you started in 2017. And also some of your best advice for people who are just getting started. But first off, I want to hear about what happened before you made this transition and what ultimately inspired you to kind of pull the trigger on your investment banking career, or I guess pull the cord on the investment banking career and make that transition.
Well, I think I appreciate the compliment. It being the pinnacle of one's career. Hopefully, that's not my swan song. But first off, appreciate you having me on the show here. For me, it came down to, as I was going to get married and we wanted to start a family, it was just really, really important that I was able to spend time with my wife and, when we had children, my children. And I just saw the folks that were ahead of me, the investment bankers that have been there for 10, 15, 20 years. They did very, very well financially. But I could see a substantial majority of them didn't have the best relationship with their families, with their wives, their second wives, their kids. And I just didn't want that for me. And I knew that had I gone along this path, I might have hit some of my financial goals, but I wouldn't hit the other goals that were just as, if not more important for me. So that was a big reason why I made the shift.
Got it. Yeah. And so what was it like leading up to that? Like, did you have like a milestone that you were like, okay, I want to get to this point in terms of passive income before I pull the trigger? Or you just were one day like, I've had enough of this and I'm going to make it work somewhere else?
No, it was definitely a gradient. It wasn't, kind of one day I just kind of decided to quit. We launched, my wife and I launched a business December 27th, 2016. So I was still working. And, we did it for probably the first year. My wife quit after 6 months in. So the first property we did, after a few months, we realized that there was definitely something here. And we wanted to scale it. For some quick numbers, by March, it was a 3-bedroom apartment that cost $2,400 a month to rent. And then maybe like $8,000 to furnish. By the third month, it was grossing over $10,000 a month. And with the rent and expenses around like $4,000 all in, we're making $6,000 on one little apartment. And you didn't need to be an investment banker to realize that this is something real, that if you can scale, it can really make a big difference in your life.
Can you,
so
I'm sorry.
We got married in March. And
just
then
to jump in, sorry. So I think people may not understand the strategy that you just referred to, because you're talking about renting it for $2,400, and they might have thought that you're renting it to someone else. But you mean you're actually renting it from a landlord so that you can control the property, and then you're renting it out for $10,000 a month. Is what you're saying?
Exactly.
Okay.
So rental arbitrage, just to take a step back, is a strategy where for Airbnb short-term rentals, where you work with a landlord, you pay them a long-term rent based on a lease, could be a year or 2 years, depending on how you want to structure it. And then with their express permission, you're allowed to re-rent it on Airbnb. So conceptually, it's like buying wholesale. You buy kind of the room nights wholesale, and you sell them retail, right? You obviously have to do work to furnish it, to decorate it, to make it desirable for someone that would like to rent for Airbnb. And then you can charge a higher price, generally speaking, at a retail level than what you bought at wholesale. And that's where you make the spread or arbitrage, and that's where the name Airbnb arbitrage comes
Awesome.
from.
And where was that first one that you did?
New York City.
Got it. And that was 2016, you said?
December 27th, 2016.
Okay, got it. All right. Thanks. Sorry.
And I remember that date because we wanted to rent it out for New Year's, so we scrambled through Christmas. Didn't really get that.
Nice Christmas gift to your wife to be setting up a house. So that was the first one that you did in 2016. Yep. You realized that there's a ton of potential. What were the next steps from there?
So we in that first year we probably got up to 7-8 units. I forget the exact number now, but my wife she quit. We got married, and then she left her job to work on this full time, and then we just got more properties to rent, and then put it on the Airbnb, and we just continued to scale that strategy. And then prior to that, we're looking at different types of rental strategies or different types of Airbnb, different types of real estate investing strategies that we could use to create wealth, create cash flow. And we bought a long-term rental and made like $300 a month. They're like, well, this doesn't really work because this will take forever to create a real business. So we were looking at multifamily. We were looking at different things, and we kind of saw this opportunity. And then we didn't know at the time, obviously, that I could do this well, but we wanted to just try it. And 3 months in, we're like, okay, this really works. So let's lean into this strategy.
Got it. Yeah. I think that's where some of the best strategies start, is just like, testing it out. What's the worst thing that can happen? People want to have it all figured out and have the end game finalized before they even take the first step. And I think it's so important just to test it out with that first step. So it's 2016, things were a lot different with Airbnb and short-term rentals than they are now, especially in New York City. So how did that scale for you from there?
So, exactly. And the market has changed, the regulations have changed. So we started in New York City because that's where we lived, and we continued to grow our portfolio there. We had, units in New York City, across the river in New Jersey, and then we eventually grew to expand in Philadelphia, which is about 2 hours away from New York. And then we took the knowledge and the cash flow from the properties and started buying, and we bought in the Smoky Mountains National Park in Tennessee. So currently our portfolio is about 30 properties. All of our rental arbitrage portfolio, our entire rental arbitrage portfolio is in Philadelphia. And everything that we own is in the Smoky Mountains National Park in Tennessee. And that was a very purposeful decision.
I see. Okay. So you transition out of New York City when they started cracking down on short-term rentals, or how did that transition happen?
It was actually COVID. So the regulations have continued to evolve in New York City and elsewhere. But to be candid, it's a big market. Municipalities are generally fairly constrained. But for us, it was a way to just get started. And our intention really was to buy. Our intention with the strategies is to eventually buy properties, right? We wanted to build long-term wealth through ownership. We understand that rental arbitrage, renting properties, candidly is not a way to really compound your net worth, but it's a really great way to earn cash flow very, very quickly and very, very efficiently with capital. That two-bedroom apartments cost maybe $10,000 to furnish, right? There's a security deposit. So all in, you're controlling a property that's, depending on the market, $500,000, $600,000, $700,000 for that property, for a $10,000 kind of investment in, and maybe $1,600 a month in rent, right? So there's a lot of embedded leverage within that lease, similar to a mortgage, right? But it just takes, the buy-in is so much smaller when you rent properties, so it's a much faster way to scale quickly and cash flow quickly.
I see. Got it. And so what made you feel like Philadelphia would be the better move for rental arbitrage, and why do you do rent arbitrage there but own properties in the Smoky Mountains?
Well, a couple of reasons. So Philadelphia we liked because it's a major northeast city, and the major ones are, if you start from Boston, New York, Philadelphia, Washington, D.C., right? And that's generally on that corridor. And all the so Boston, New York, and D.C. are all heavily regulated, and so is Philadelphia. But Philadelphia, you can employ this strategy in certain zonings, right, that are commercially zoned. And if you get the right zoning permit and you get the right rental license, you're okay. So that was very purposeful. We kind of learned our lesson. And it was very purposeful to make sure that our properties were in multifamily, commercially zoned properties where we were able to kind of get scale advantages. And that was one thing that we also learned as well, was we wanted to be in large multifamily buildings because it just was so much easier to scale with one landlord who had a lot of units. We're kind of solving a vacancy problem for them. There's only one front desk, there's only one roof, so there's just fewer variables to control. So it's a lot faster to grow that way. in Tennessee, but that market, if you buy, it's a different set of math that you have to run versus rental arbitrage. And generally in these kind of urban core cities, it's a lot harder the math doesn't pencil out as well as if you were to buy somewhere else like the Smoky Mountains. There's also a number of tax advantages, namely with bonus depreciation that will allow you to really compound your capital in a very tax efficient way. So there's a lot of kind of variables at play, but quite simple, if I was to kind of simplify it, rental arbitrage works really, really well in an urban environment that allows you to kind of scale quickly. There's a lot of different demand vectors within those cities, right? So Philadelphia, for example, sports, business, medical, education, tourism, there's a lot of reasons. There are a lot of people that go to Philadelphia for a lot of different reasons, right? So that's, for us, is a great rental arbitrage market, but there's a lot of regulation in those markets as well. So, but and when you buy something, you want to make sure, it's a 30-year, our intention is to hold that for a very long time. So you want to make sure it's a place that welcomes short-term rentals, that there's a history there, the economy is very, very geared towards that, so that the sand doesn't shift below you and you're left with an asset that can't perform in a way that you initially underwrote.
Yeah, that makes a lot of sense. And I haven't heard people talk a lot about that, how, rental arbitrage and owning short-term rentals work much better in different markets. A lot of people kind of clump them together. I'm just going to pick a market to do both strategies in. So I think that makes a lot of sense what you're saying, because there's probably a premium on these condo units in downtown Philly where the cash flow doesn't work as well as an owner, but it works great as in an arbitrage situation. So
let me give you another kind of easy example I think for most investors. I think they're very kind of attuned to this. When you buy a long-term rental, what's one really important thing, right? School zones. Right? You want to be in a good school zone because then families are always going to rent there because they want their kids to go to good school, like all of us would do, right? For rental arbitrage, it doesn't really matter actually what school zone you're in, right? Because they're only there for a short while, so you're not paying the premium for that good school zone where you would be if you were looking to buy something, right? So that's just one thing where it's one of the things where it really matters for a long-term investor, an investor that's renting out long-term, but for a rental arbitrage investor, for a short-term rental investor, it doesn't matter as much, and that's where you kind of can play the differences in price to make a good return for yourself.
Got it. Yeah, that makes a lot of sense. And so for you personally, what do you target in terms of numbers? Do you have like a rough number that you target in terms of if you're going to take on a rental arbitrage, a new one, to make it worth your while, or to purchase a new short-term rental?
There's a different set of considerations just because of the depreciation when you own properties, right? So when you own something, obviously it can increase in value. You get the depreciation, and then you can take the depreciation benefits that will help you defer taxes. But rental arbitrage, you can't do that. So rental arbitrage, we look for a certain ratio between the revenue that we think we can make and the rent we're paying. So generally that's 2.25, 2.5 is what we generally look for. And we have a minimum amount of cash you want to make per unit. For us now, it's like there is a return on hassle, right? Something that could make a really good percent return, but makes like $500 a month, $700 a month. Like that doesn't really move the needle for us, so that's not something that we would do. So there's kind of minimum threshold. We want a certain ratio to rent that we're paying, and there's a minimum amount of dollars, the dollar margin that we want to earn. On buying, we're looking for properties that are in good areas that are going to appreciate, right? So again, areas that have a long history of rentals, of tourism, short-term rentals. In the South, it's called overnight rentals. And just depends on that property, if there are certain tax advantages, to buying that, if the land's expensive, et cetera. But kind of to simplify it, we're looking for something that will a revenue to purchase price of 15 to 20%. So if we're buying a property for $1 million, it should do between $150,000 and $200,000 of gross revenue per year.
I see. Okay.